Hey everyone, welcome back to Corporate Decoder. Today we're diving deep into ADM Tronics Unlimited Inc.'s latest financial report, and let's just say we're going to try to make sense of whether this company is truly unlimited or hitting some pretty big speed bumps. Alright, so we're looking at ADM Tronics Unlimited's annual report, essentially their yearly checkup. It tells us how they did over the past year, which ended on March 31, 2025. Think of it as their financial report card. First up, let's get a feel for what this company actually does. ADM Tronics isn't just one thing. They're a tech company that makes and sells a few different types of products. They create electronics for medical devices, things that help doctors and patients. They also make eco-friendly chemical products for different industries, and they offer services in research, development, and engineering. It's a bit of a mixed bag, which can be good or bad depending on how you look at it. On the electronic side, they're focused on medical devices used for diagnosis and treatment, but also for veterinary use and other areas. Their main manufacturing spot is in Northvale, New Jersey, and it's approved by the FDA, which is key for medical devices. They do their own product development and also make things for other companies as a contractor. Speaking of contract manufacturing, as of March 31, 2025, they had a backlog of about $956,000 in orders for these electronic products. A backlog means they have orders they're committed to fulfilling, which is a good sign of future business. Then there are their chemical products. They've got water-based primers and adhesives, coatings, resins, and additives for the printing industry, especially for food packaging. They also have anti-static products through a division called Anti-Static Industries. This is pretty interesting because they're focusing on being environmentally friendly, using water-based solutions instead of solvent-based ones, which are known to be more harmful. They're trying to reduce static electricity issues in industries like electronics and pharmaceuticals. They've also developed some topical products for medical and cosmetic uses, including formulations for maxillofacial prosthetics and makeup for film and TV. On the services side, they offer research, development, regulatory, and engineering services. Basically, they help other companies design, develop, and manufacture their own technologies and products. Now, a really important point for any business is who their customers are. It seems ADM Tronics is quite reliant on a few big clients. For the year ending March 2025, 2 customers made up nearly half of their total revenue. And at the end of that same period, 2 customers represented over half of all the money owed to them. This is a big risk. If even one of these major customers decides to take their business elsewhere, it could really hurt ADM Tronics. They mentioned they manufacture their products at their single facility in Northvale, New Jersey. This single location is another point of vulnerability. If anything happens there, like a natural disaster or a major operational issue, it could stop production across the board. They also talked about their reliance on suppliers for raw materials and components. They've been facing global shortages, especially for electronic components, which has led to manufacturing delays and higher raw material costs, squeezing their profit margins. They're trying to find other suppliers, but it's tough out there. For research and development, they spent about $517,000 in the last fiscal year and $576,000 the year before. This is money spent on developing new products or improving existing ones. They admit they're in highly competitive markets, and many of their rivals have more money, experience, and better marketing. This is a major hurdle for a smaller company like ADM Tronics. Now let's talk about risks. Companies are required to tell us what could go wrong, and ADM Tronics is no different. They're exposed to environmental regulations, which can increase operating costs. They also face operating hazards in their manufacturing facility due to the chemicals and materials they use. If new environmental rules come into play or if there's an accident, it could be costly. They're also worried about not being able to keep up with the competition if they can't innovate and improve their products. This is a constant challenge in technology and manufacturing. A key weakness they highlight is that their chemical products aren't protected by patents. This means competitors can more easily create similar products, making it harder for ADM Tronics to stand out. Remember that single manufacturing facility we mentioned? Well, here again, they point out that if their operations are interrupted, their customers could face serious delivery problems. And because it takes time to find and approve a new manufacturer, their customers might lose their own clients. They also have concerns about their intellectual property, meaning patents and trademarks. They mention that the patent world for medical devices is complex and uncertain, and there's always a risk that their own patents might not hold up, or that they could be infringing on someone else's patents. This is a big legal and financial risk. And back to the FDA, they operate under strict regulations for medical devices. If those regulations change, it could mean high costs for them. This next part is super important. The report states that the financial statements are prepared, assuming the company will continue operating. They've had losses and negative cash flow, and as of March 31, 2000, email Dell about their ability to keep going. This is known as a going concern warning, and data made over time while management is trying to turn things around. There's genuine doubt about their ability to keep going. This is known as a going concern warning. They're heavily dependent on a few customers for revenue, and there's no guarantee they'll keep those relationships. Additionally, their financial controls aren't perfect, and their insurance coverage for product liability might not be enough. Losing key personnel is another risk, and the company's CEO and his family have significant control, which could impact other shareholders. Let's look at how their stock is doing. It trades on the OTCQB marketplace under the symbol ADMT. The prices have been pretty low, hovering around 7 to 13 cents for much of the last 2 years. For example, in the first quarter of 2025, the high and low bid were both at 7 cents. That's not exactly a stock that's going to make you rich overnight. As of March 31, 25, there were about 1,318 shareholders. And don't expect any dividends. They haven't paid any in the past and don't plan to in the foreseeable future. They need all their earnings, if any, to reinvest in the business. Now for the numbers, the real meat of the report. Let's see how ADM Tronics performed financially. Revenues went up by about 8% from the previous year, totaling $3,197,110 for the year ending March 2025. This increase was mainly driven by their engineering services segment, which grew significantly by about $32,000. But even with higher revenues, they still had a loss from operations. The loss shrunk quite a bit though, from $877.22 to higher gross profit from sales and a reduction in operating expenses, especially in selling, general and administrative costs. This translates to a net loss of about $123,000 for the year, or a loss of practically 0 per share, E0.000C040 per share. So they are moving in the right direction on their losses, which is positive. In terms of cash, they had about $383,000 at the end of March 2025, down from $537,000 the year before. They expect to have enough cash to run the business for the next year. They also mentioned getting loans under the Paycheck Protection Program, or PPP loans, during the pandemic. Most of these loans were forgiven, which is good news, but they still have a small portion converted into a term loan with a very low interest rate. This is a critical figure, cash provided by operating activities. For the year ending March 2025, it was a tiny positive number, just $9,978. This means their core business operations barely generated any cash. The year before, it was a negative number, meaning they spent more cash than they brought in from operations. So while the number is technically positive this year, it's so small it barely counts. In investing activities, they spent $225,750 on investments, which is a significant chunk compared to their total cash. Financing activities show they took on more debt or equity. They had $61,700 in net financing provided, mainly from their line of credit. Now let's look at their balance sheet. This is like a snapshot of what they own and what they owe. Their accounts receivable, which is money customers owe them, increased quite a bit to over $975,000 after accounting for potential losses from customers who might not pay. Their total current assets, which are things they can quickly turn into cash, are about $125 million. On the other side, their total liabilities are around $1.45 million. This means they owe more than they have in quick assets. And their stockholders' equity, what's technically left for the owners, is about $671,000. This reflects that accumulated deficit we talked about earlier. Let's revisit the income statement for a moment. We saw revenues increase to $3,110, but the cost of making and selling those products was $1,018 and $1,450. This gives them a gross profit of $1,395,660. That means after paying for the direct costs of their goods, they have this much left. However, when you add in all their operating expenses like R&D and admin costs, they end up with a loss from operations. Looking at the cash flow statement clearly shows the struggle. The most critical line is that net cash from operations, which was a measly $9,978. Think about it, for a whole year of work, they barely scraped together enough operating cash to cover a small bill. Investing activities used up a significant amount of cash, $25,750 possibly for new equipment or investments as noted earlier. The notes to the financial statements offer more detail. For instance, Note 1 confirms their multifaceted business lines: electronics for medical and other uses, chemical products and engineering services. They use estimates for things like potential bad debts, inventory values, and other financial aspects. This is normal, but it means the actual results could differ. They set aside a large amount for potential uncollectible accounts, showing they're aware of potential payment issues from their customers. They break down revenues by geography, showing that most of their business, $2,856,136,130 happens in the US, with only about $340,977 coming from outside the US. This re-emphasizes that customer concentration risk, with 2 customers making up almost half of their revenue in 2025. Looking at their different business segments, electronics is their biggest revenue generator, followed by chemicals and then engineering services. However, engineering is the only segment showing a profit, while electronics and chemicals are losing money operationally. This suggests a shift might be needed, focusing more on the profitable service side. The company carries a significant valuation allowance against its deferred tax assets, which basically means they don't expect to realize these tax benefits in the near future. This is often a sign of an ongoing loss-making situation. They have investments that are valued at fair value. Some are considered level 1, meaning they're based on readily available market prices. They have about 150,750 are in level 1 investments. However, they also mention that some investments are at cost or net book value, which is a departure from standard accounting practices, indicating these investments might be hard to value accurately or are in less liquid markets. This is the most critical takeaway from the entire report. The auditors themselves are raising a red flag, stating there's substantial doubt about the company's ability to continue as a going concern. This is a serious warning that the business might not survive without significant changes or new funding. They acknowledge that their internal financial controls aren't fully effective, partly due to staffing shortages and a lack of segregation of duties in their accounting department. This means there's a higher risk of errors in their financial reporting. Interestingly, the company seems to be run by just one key executive, Andre Domino, who holds multiple critical roles. This concentration of power and responsibility can be both a strength if he's incredibly effective, or a huge weakness if anything happens to him, or if he's spread too thin. They also don't have independent directors on their board. The CEO's salary has significantly dropped from $186,000 in 2024 to $108 in 2028. This might reflect the company's financial struggles or a re-evaluation of executive compensation. He has an employment agreement with a base salary, but it's clear the company is conserving cash. Andre Domino and his family appear to own a substantial portion of the company, around 28%. This means he has significant influence over the company's decisions. They used 2 different accounting firms in the last year, which might indicate some instability in their auditing or accounting relationships. Up now, let's put on our analyst hats and look at the big picture for ADM Tronics Unlimited. This company is clearly in a tough spot. They're trying to operate in multiple diverse industries with limited resources, and competitive pressure is high. The fact that their core operations barely generated any cash this past year is a major concern. Couple that with the auditors' warning about their ability to continue as a going concern, and you have a business facing significant survival challenges. The reliance on a few key customers and the lack of patent protection for their chemical products are significant weaknesses. On the positive side, they are managing to reduce their operational losses, and their engineering services segment appears to be a growing area. However, this isn't enough to offset the overall struggle for profitability and cash generation. For investors, this report paints a picture of a company in a precarious financial situation. The going concern warning is not to be taken lightly. While there's potential in certain segments like engineering services, the fundamental issues of operational cash flow, competitive disadvantages, and financial control weaknesses need to be addressed urgently. Without substantial new funding or a dramatic turnaround in their core operations, continuing as a viable business in the long term looks like a significant challenge What's your take on these numbers and what they signal for ADM Tronics Unlimited's future? Let us know your thoughts in the comments below. If you found this breakdown valuable, please hit that like button to help us reach more people and subscribe for more deep dives into corporate filings. Don't forget to check out our Discord community linked in the description for more exclusive content and discussions. Thanks for watching, and we'll see you in the next video.